All right, so today we're going to be talking about derivatives. And no, we're not talking about calculus. So let's keep on going here. All right, so for derivatives, I'll be honest, it's another name for options. Okay, so it's another name for options. Derivatives is interchange between this and that. Okay, so options is something where you pretty much go to the market and you're like, I think it's gonna go up in value. So I'm gonna put money on that. So if it goes up in value, we're gonna get some money back. Okay, but if it goes in the opposite direction, we lose that money. Okay, that's the gist of what derivatives is you're putting money in the market, you're expecting to go a certain way. If it goes the other way, then you lose money. Okay, let's keep going. All right, cool. So right here it talks about call and put options. So that I'm going to be going over in a little bit. And then right here talks about opening, purchase, close, and sell. This right here is something that you're going to have to understand. And I will be honest, for me, I still get confused between these two right here. So you got to understand, because what if on the exam they ask you this? Okay, so make sure you guys understand that this right here. Okay, any questions so far?
Is that related to call and put options, opening, purchase, and
Yep,
opening?
exactly.
Okay.
So options. Okay, let's keep going here. So anytime when you have a contract, you can either be one of two people. You can either be the buyer or the seller. Now, when you're the buyer, you bought the contract and you have the right to exercise that contract or not. Okay. Now, as a seller, you sell this contract to this buyer. Okay. Now, when you sell to that buyer, you're hoping as a seller, they're not going to exercise that contract because you get to receive and keep that premium. Okay, so if you don't exercise it, you keep that money. Okay, right here it takes on obligation, because if the buyer, if they exercise the contract, they're gonna have to do whatever that contract says, if it's to buy or to sell. Okay, let's keep on going. Let's go here. All right, cool. So for calls in general, we're expecting the price to go up, the stock. Okay, so for long call, so the buyer owns the right to buy 100 shares of a specific stock at the strike price before the expiration. If he chooses to exercise the contract, therefore a call buyer is bullish. So bullish, I want you guys to imagine a bull. But when you look at a bull, what direction are their horns? Exactly, they're up. So their horns are up. That's why it's called bullish. Okay, so they're expecting to go up in value that stock. Okay, let's keep going. So this is the way you're gonna read the options. It's gonna look like this. Long. This is this is gonna be the company, the month of expiration date, expiration, and this right here is gonna be the strike price. The strike price. And then 3 is gonna be the premium. Okay, so right now off the back, anytime you want to look at a question, all right, cool. We have right here a long call. So for a long call, we're expecting the price to go up over time. We're bullish. Okay, now we know for a fact our premium is going to be 3. That's what it is, okay? Our premium is gonna be 3. And if you want to find out how much you paid, all you gotta do is literally this one here, you gotta imagine it's 100. So you're gonna times 3 times 100, and it'll give you $300. So $300 is what you paid for that contract. Okay, any questions? You guys got it? Got it? All right, cool. Pretty simple. Let's keep going. All right, now right here we have the term short sell. Okay, so short sell, the seller has the obligation to sell 100 shares of a specific stock at the strike price. If the buyer exercises the contract, therefore a call rider is bearish. Okay, so right here, like I'm probably getting already confused, right? So the simple way to actually memorize this right here is that it's for calls and options. There's a little table right below here in the bottom section. Somewhere around here, there it is. Cool. So this little table, it's gonna help you for the exam. So here has long call, long put, short call, and then short put. So for long call, it's the right to buy. Okay, so we're bullish. We're expecting the price to go up. Okay, and then puts, we're bearish. We're expecting to go down. Okay, and then right here, short call, it's if you forget what it is, you just do the opposite direction. The opposite direction of this one right here. So you go down and you go up. Okay, you don't have to necessarily memorize everything here. As long as you know one side of the quadrant, you know the other side. So for the exam, when you get into the exam, you're gonna do this right here. You're gonna draw it out. Calls, puts, long call, and then short. You're gonna draw it out, and you can draw the arrows. Bam, 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 bam. And on the bottom right here, I put right here, it's a buyer. And then right here, I'm gonna put right here, seller. Okay, so this right here, it'll help you at the exam. Trust me, it's a lot easier memorizing this right here as opposed to memorizing all those definitions on right here, which is good to know, but might confuse you in the long run. So this right here, just knowing this right here, it's enough. Does that make sense? Jason, you look confused.
I'm just following along, Oscar. I'll get it eventually.
You get it eventually. And this right here is like, it's literally the easiest section to get the questions like are correct. Okay.
It makes sense, but I'm gonna look over it again. That way I can understand more about it.
Cool, cool. All right, let's keep going. All right, cool. So right here are some basic terms. So for calls, let's go a little bit down here. All right, cool. Let's go right here. All right, so for calls, in order for it to be in the money, it has to be, here it is, when the price of the stock exceeds the strike price of the call. A buyer will exercise a call that are in the money at expiration. Buyers want the option to be in the money. That's where they make what?
Profit.
Yep, exactly. Profit. They want to make money. All right, perfect. So let's say that the strike price is, let's say the strike price is 60. Okay, that's the contract here. We have 60. Okay, and now the current market price is $80. Current market. Okay, current. Right now it's $80. Right now, are we in the money or out of the money or intrinsic value? Which one is it?
In the money?
Yep, in the money. Right now we're above 60, so we're in the money. Now at the money, all this means here is that the strike price, it's gonna equal the current market price. Okay, here it is. We call it the money when the strike price equals the stock price. Okay, a buyer will not exercise a contract that are at the money expiration date. Because if it's at the money, they're not going to call it because either way, they're going to lose money. They'd rather just lose the premium with the paid. Okay, so here it is. Sellers want at the money contract expirations. Buyers do not. Okay, now here says out of the money. So out of the money is very simple. If our current market price is below 60, let's say 50. Let's say our strike price is 60 and our current price of the market is $50. So right now we're out of the money. We're negative 10. So we're not going to exercise this contract, and the person that sold this contract is going to keep that premium. So they're happy. They're going to win that premium. Okay. Now here with intrinsic value, as long as it's above the strike price, it has intrinsic value. Okay, does that make sense? Here it is. Has intrinsic value when the market price of the stock is above the strike price of the call. So as long as you're above that strike price, you're good. Okay, so that's assuming that it's a call. Okay, now here parity. So parity is very easy to solve. Okay, so let's say that our strike price is 60, right? And then our current market price right now is going to be, let's say 65. Say 65. So we're going to do this, 60 minus 65. So that's going to be equal to 5. Okay. So right here, our intrinsic value is going to be equal to 5. Okay. Now, let's say that our premium is equal to 5. So if our premium equals 5, that means that we have parity. Here it is. Is a parity when the premium equals intrinsic value. Okay, so let's say our premium, it was 4. Does 5 equal 4? No, right? So it does not have parity. Okay, so overall, these terms, they're going to be used interchangeably between calls and puts. The only difference is that you have to understand for calls, we wanted to go up. For puts, we wanted to go down. That's the main difference here. Is that the direction for the end of the money is going to be opposite direction, but the way you do the math, the same way.
Hey Oscar, so could parity also mean like when you're breaking even?
Yep, you're there. There you go. That's break even point, pretty much.
This might sound like a dumb question, but how do you get the premium? You were talking about the intrinsic.
They give it to you.
They give it to you on the exam?
Yeah, they're gonna give it to you. I just made up a number right now for shits and giggles.
Okay, for sure. I thank you.
All right, and we'll do this one here. All right, so right here we have. Let me move my this little thing up there. All right, cool. Here it is. So ABC stock is at 62. So 62, what is 62 right now? What is that?
Strike price?
Strike price.
Nope.
Current.
Oh, the current market one.
Exactly, the current market. Okay, perfect. Now right here we have ABC June. That's the company. The expiration date right here for June, and then 60 is what?
That's the strike price.
Yep, the strike price, exactly. Now, right here, we have call. Okay, so call, we have call, that's a type of option, and then trading at 2. What's 2?
The premium.
200.
Yep, 200, right? But in this case, it's the premium, right? There you go, premium. So now, so right now, we're gonna find out if it's in the money, if it has intrinsic value, etc. So now, to find if it's in the money, what are we gonna do?
Do you subtract it?
Okay, but why?
Because we're looking at the strike price to make sure that the current market value is above the strike price.
Yep, and the reason why we're doing that is because what kind of option do we have?
A call.
Call, exactly. Calls, we want to have it go up. So we're gonna get the 6.2, which is this, the current market price minus 60. So that's equals 2. So now, what is the intrinsic value?
2.
Exactly. This is right here is the intrinsic value, the IV. Okay. Now, how do you find parity? How do you find it?
The premium should equal the intrinsic value.
There it is, 2.
I'll say
So
that.
right here, we have parity. If this right here was 3, then we wouldn't have parity. Okay. Any questions, or you guys got it?
So just to clarify, so when they ask you a question, sometimes they'll throw you off and say the call is trading at 5, right? And if when you do the subtraction, if it equals 3, that means that there's no parity, right? Just kind of that makes
Exactly.
sense.
They'll put in whatever numbers they want, throw you off.
Okay, for sure.
Also, Oscar, this may sound like a dumb question, but so where it says ABC June, like what is that? Like is that
Oh,
like the month?
ABC is a company, like the stock, like Microsoft.
Right. So what about June? Like
June
is
is
that
the expiration date of the contract.
Oh, okay. All right, makes sense.
All right, let's keep going here. All right, so now we have puts. So right here with puts, we're expecting the price to go down. So we want to go down for us to make money as a buyer. Okay. So here in the money, let's say our strike price is equal to 60. Our current market is equal to 50. So right here in the money says is when the price of the stock is lower than the strike price of the put. A buyer will exercise the put that are in the money at expiration. Buyers want in the money contract, sellers do not, because they keep the premium. So now if our strike price equals 60 and our current market price right now is 50, are we in the money right now? Are we in the money?
Yes.
Yep, we're in the money because we are literally below 60. Because that's the spot we want to be at. We want to be below 60. Now, at the money, it's the same thing. We want the strike price equal to the current market price. So it's 60. It's 60 right here, and then it's at the money. Here it is. When the strike price of the stock equals the put. That's it. All right, and then out of the money is pretty simple. So remember earlier for calls, it was out of the money if it was below, right? Now for puts, what do you think it is if it's out of the money?
Higher than the strike price.
Exactly. If let's say we have right here 65. This 65, it's above the strike price. So right here, we're going to be out of the money. So when it's out of the money, we're not going to exercise that contract. We're just going to let it expire and cut our losses. That's it. Okay, and intrinsic value, we solve it the same way we did for calls earlier. All we do is, I'm going to make it so it's easier here. Let's put right here, let's put here again, here 50. So you get right here the 60 minus the 50. So that's 10. So intrinsic value is going to be 10 here in this case. Okay. Now here, parity, let's say our premium is equal to 10. So if our premium is equal to 10, then this right here, it's at parity because the intrinsic value equals parity. I mean, equals the premium. Any questions, you guys? You guys got it?
So just to clarify, Oscar, it's literally the opposite. So when you're on a
Mhm.
call, you want the price to be above the current price to be at above strike price. But when you're on puts, you want it to be below strike price, or yeah, below strike price, so you make money, right? Because
Yep, exactly. And for that, if you get confused here and there, all you gotta do is look at, I think I already passed it. Let me go back up here. Remember that chart with the 4 quadrants?
yeah.
So reference this chart while you're doing the example problems. It's like your little cheat sheet, because when you get to the exam, they give you a piece of paper, and that piece of paper, when you walk in the first 5 minutes, you write down whatever equations, information you can memorize and put it on the paper. That's what I did. All right, cool. Let's keep going. Oh, this right here is very important to know right here. Let me get my little pen. So right here, it's another equation when they give you options. Intrinsic value plus time value equals premium. Okay, so right here, let's say that they want you to find the time value, but they gave you the premium and they gave you the intrinsic value. So let's say that in IV equals 3, premium is equal to 2. So all you gotta do is literally do TV, right? Equals, moves to the right hand side, PR minus IV, and then 2 minus 3. -1. Yep. But once in a while, they'll throw us on the exam. It's like the only equation you kind of have to memorize for options. Any questions right here? This is like basic algebra. Any questions? Ask right now.
okay, Oscar, can you repeat it one more
All
time?
right.
Sorry,
I was gonna ask that.
can you repeat it, please?
Remember, I took 3 levels of calculus and differentials. So for me, it looks easy, but yeah. So all this here is that I'm gonna look for the question here, and I think right here it asks for, there's a question here about it right here. But they'll throw you something out where you have to solve for one of these variables here. And all you gotta do is literally plug in whatever they give you in the equation and just find the time value. That's it. So I'm gonna look for an example here. I think it's here somewhere. Let me see. We'll see it in a bit. I remember seeing it come back on the book. Oh well, it'll come up. Let's do the quiz. All right, an investor is long. Okay, so we know it's long, and he has a call. So he has a long call. So now the first thing we're gonna do here is that we're gonna draw out the little chart, right? So we have here we have long, we have short, call, short, bam, 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 bam. All right, cool, perfect. I'm gonna draw it backwards. You can do either on this quadrant or over here. Same thing. All right, so an investor Okay, so what's 40 here? What's 40?
Strike price.
The strike. Okay,
Strike.
there. Okay, an investor is long. Okay, 1. XYZ stock has a current market price of 44. So now we're gonna find out if it's in the money. So out the back right now, we know that it's above 40, right? So out the back, we know that it has what?
Profit.
It's
Intrinsic
profit,
value.
right? But what's the other word for it?
Intrinsic value.
Intrinsic.
Yeah, that's true, right? But the simple term,
In the money.
in the money. There you go, in the money. So now we're looking for that word right there. So off the back, we look at A, it says here May 40 is at the money. That is wrong. If it was at the money, then the current market price will be 40. That's wrong. Okay, and then B, the May 40 call is in the money. This right here, it is true. All right, let's look at the rest. May 40 call is out of the money. Is that right or correct?
False.
That's
That's
false.
false because why?
It's in the money.
Current value is above 40, so it's in the money.
Yep, there you go. It's wrong. Now the May 40 call has no intrinsic value. Is that correct?
It's false
That's false.
And then why is it false?
because it has value. It has a profit.
Yep, it has a profit. It's above the strike price. So in this case, it's going to be B. All right, 2. An investor is long 1 August XYZ 30 put, and XYZ has a current market value of 25. All right, so out the back, we have here long and then put. So for long put, we're going to look at right. Oh, it's right here. I wrote short again. Here, put. Here it is. Long put. So we want to go down in price. There it is. We want to go down. Okay, so now we're going to look right here, right? So we have a long put and we want to go down in price. Now, off the back, right now we have the current market price of 25. The strike price is 30. Right now, are we in the money?
No.
Yes.
Oh,
It's a put. Remember, it's a put.
no.
So it's a put. So we want to be
Yes.
below the
Oh,
market.
so yes, we are. Okay.
Okay, so we want to be below the low. So it's gonna be in the money.
Okay. Yeah. Oh,
What's
actually,
going on,
it's the
dudes?
opposite.
All right, so in the money right now, right? Now, looking right here, number 8. August 30 put is in the money by 5 points. That is correct. Because you get 30 minus 25. So we're in the money by 5. That's correct. So we're going to leave it there as an option. Now, B, the August 30 put is at the money. So in order for be at the money, what has to be this value here, the current market value?
30.
30.
Exactly 30. So C is wrong, right? Now, D, the August 30th put has no intrinsic value. Okay, this right here is wrong, right?
Right.
Okay, so that's wrong. All right, so now it should be right here, B. Now, 3, an investor sells a July 25 ABC call.
Oscar, would it be A? Like, or like why is it B? Because wouldn't it be in the money?
Oh, my bad. I don't know why it did B, but you're correct. Should be A. I circled the wrong one. There you go. And then 3. At least you're paying attention, George.
Let's go. Trying to get licensed.
I know. At least we know you're getting sleep and not too much from the baby, right? All
Not
right.
for real.
An investor sells a July 25 call. Which of the following is true? You're like, what the hell does that mean, right? All right, so it's a call. So we know off the back that the investor, he wrote this and he sold it to a buyer. Okay, so as an investor, I don't want them to exercise that contract. That's what I'm thinking right now. I want to have it expire. So here it says the investor has the right to purchase ABC stock at 25. Is that correct? Or should I be the buyer?
I should be the buyer.
You think so? You think it's A wrong?
Yes.
Yeah, it's wrong.
Yeah, that's wrong.
All right. And then B, the investor has the right to sell ABC stock at 25. Is that correct?
Yes.
Yeah.
No,
No, wait, no. It's not correct. It's not correct.
Is this the kind of question you're gonna be like a little bit confused? You gotta think a little more.
I
And then
think
C,
that's wrong.
the investor will be obligated to purchase ABC stock at 25 if the call is exercised by the owner, the buyer. This one here sounds like it's a bit more
Correct.
correct, a bit more correct. Now here says D, the investor will be obligated to sell ABC stock at 25 if the call is exercised by the owner, the buyer. Okay,
Yes.
so the only difference between these two right here is that to purchase and to sell. Okay,
So
so
the answer C?
you think it's C?
I think it's D.
Yeah, it's C.
All right. Ba-ba-ba-ba. Now,
Wait,
four.
Oscar, so just to clarify before you move on, I'm sorry everybody else if you guys understood it. But so as an investor, you don't want to purchase it back because then you lose money. But when it's
Exactly.
a seller, you want to sell it. No, wait. So if it was a put, then D would be correct, or am I tripping? Does that make sense? That makes sense?
Don't overthink it.
Okay. All right.
So right
I
now
think that's just my opinion.
we're trying to see the concept. Okay, and then four, an investor writes a September 65 ABC put for $3 when the stock is trading at 63. So this right here is the current market price, current. Okay, and then 3 is the premium. Okay, and then 65 is what?
Strike price.
Exactly, the strike. Okay, so right here off the back, it tells us here it's a put. So we want to go down because if it doesn't tell me that's a long call, short put, whatever, long put, short put, then automatically I'm going to assume that it's going to be a long put. Okay, so I'm going to assume that I wanted to go down, so I'm going to assume it's a long put. So now we get to 65, right? And we look right here at 63. So automatically we see that it's in what?
Money.
The money, right? So we get 65 minus 63. So that's equal to 2. Okay, so this right here is going to be equal to, I'll make my pen again. There it is. Pen. So this 2 right here, it's going to be our intrinsic value. Okay. Now, right here it says for A, the intrinsic value is 3. That's wrong. It's 2. The intrinsic value is 2, and the time value is 1. There we go. That like there's the little equation I showed you guys earlier. Okay. And right here it says the intrinsic value is 1. That's wrong. We're gonna cut out. And then D, the investor has the right to purchase ABC stock at 65. Does that make sense?
No.
No.
All right. So now it should be automatically, you're like, oh, cool, it's B. But you're like, you know what? I want to make sure it's actually B. So you got to find that time value. So right here, it was premium equals time value plus intrinsic value. So now we do time value equals PR minus intrinsic value. So now we get the premium, which is 3 minus the intrinsic value, which is 2, 1. So it should be B, right?
Yes, that's pretty cool.
Makes sense. That's cool. Yeah.
I wonder who's that.
All right, perfect. Let's keep going. So right here it says 1 is B. Okay, 2 is A. All right, and then 3 was D. Here it is. So 3 we got it wrong. But at least on the exam, we were 50-50. It was either between.
Dang, you got it wrong? What?
Yep.
That doesn't make sense.
I didn't.
Yep. Angel's like, I had it right.
I had 3 right too.
Okay. But it was 50-50. As long as you go on the exam where you're like, you know what, it's between these two, you have 50% chance of getting that question right. All right. And then 4 is gonna be D. My bad. 4 is B, my bad. Easy peasy. All right, so now we're right here with non-equity options. I'll be honest, for these options part here, I honestly just skip it because I feel like it's not really relevant on the exam and it won't really come up on the exam. But what will come up is these terms here. What's the premium? What's the break-even point? What's the intrinsic value? And then what's the time value? That is something definitely will come up on the exam. So just later on, look into these examples here. Interest rate options. And then interest rate options here, it's the same thing as call and put, except that you're expecting the interest rate to go either up or down. That's it. Like this part here for the exam, it wasn't on my exam or the material I actually studied for it on my exam. So you guys get bonus questions on your exam. Currency options. So right here is going to be your what? Your Forex. Currency options. Now, currency options, it has to do with the price difference between like the dollar versus the yen and that kind of stuff.
Hey, Oscar.
Yeah.
Are you doing a Forex within Primerica or what?
Oh, hell no. No,
Oscar's a part-time Forex trader.
I won't do Forex. No. I'd rather go to a rate again. All right, cool. So here we have your American style versus European style. So for American style and European, it's a bit different. My phone's already telling me to go to bed already. I'll ignore it. All right, cool. So American style is very simple. Allows the owner of the contract to exercise the contract anytime they want before expiration date. Now, European style, it only allows you to exercise the contract at expiration date. That's all you can do. Everybody good there?
Can you just repeat
Yes, sir.
what you just
Huh?
Can you repeat it?
So American style, you can call the contract anytime you want while it's active. It's before the expiration date. European style, you can only exercise that contract on expiration date. So if it's down the entire month, you can't do anything for European. You have to wait until it expires on that date.
That sucks.
Yep, it does.
So basically saying if American style, like if the market, like the price of the contract is down, you can just pull it out so you don't lose any more money. Otherwise, like in your
Exactly. That's all it is. But remember, for options, you only lose what you put in if you call the contract. Make sense? So even if it's down like $1,000, you're not gonna exercise the contract. You're just gonna let it expire because you're not gonna exercise and lose more money than you actually lost. All right. So number one here.
So, Oscar, I have a quick question. So would you say, options are a lot better than stocks?
It depends on the person's risk level. So if that person's very conservative, no way in hell they're going to do options because options are very, very risky, especially if you don't know what you're doing. But if you're already doing, like say today, stocks, you know what? I'm going to try options for shits and giggles. I'm a bit more aggressive. So you're going to try options. Like, oh, shoot, I lose $1,000. No big deal. I'm going to try again.
Sheesh.
So it depends on the person. Okay. So here it is. Your customer is a large exporter of electronic devices. They are delivering a large shipment to Japan and are concerned that the value of the Japanese yen may drop before they receive payment. In order to hedge this currency risk, your customer should, let me see. So we're going from Japan. Where was it at? For I would say maybe if they're expecting to go down, then I'm gonna say they're gonna have to buy a call.
But, oh, really?
It's the opposite. It's kind of like insurance. Okay, so I would say either. So it's gonna be definitely a put. Yeah, it's my bad. It's gonna be a put. So between either C or D.
See, Oscar.
See? And it's right here, it just honestly just comes down to like practicing the questions and just studying. All right, so an investor might make money in a strong bull market by selling short, okay, buying equity index of puts. This one right here is like the section I skipped. So you just guess.
would it be D?
All right, cool. D. And 3.
I'll see.
I don't matter. All right, and 3. If the owner of an option may only issue exercise instructions on the last day of trading. This is gonna be an example of what the last day I can only do changes.
European style?
Yep. All right, let's clear these out. So 1 is C.
I was wrong.
Buy yen puts. Okay, and then 2 is C. Buying equity index calls. Okay, and then 3 is A, easy peasy. So let's go back to like for the indexes and whatnot. All right, you guys learning?
Yes.
Sir.
Yes, sir.
Yeah, I gotta hold you guys' hands while I teach you guys when I taught myself everything. All right, cool. And then here we have option calculations. So this right here, it looks at the break-even point, the maximum gain, the maximum loss. So overall, once again, when it comes to kind of stuff, we want to look at the big picture, the concept behind it. Okay, so let me skip a little down here so I can get a little bit of everything here. There it is. All right, cool. Let's get the pen. We're almost done. All right, so long call. So remember that the call buyers are bullish. They're expecting to go up. By purchasing calls, an investor can profit from an increase in a stock's price. Now, break even is found by adding the strike price and the premium. Okay, so break even equals strike plus premium. Okay, so let's say our strike price is 60 and then our premium is equal to 5. So our break even is going to be above 65. Okay, so now let's say that the current market price is 70. Okay, so at 70, we're like, you know what? I'm going to call the contract. I'm actually above my break-even point. I'm going to call the contract. But if that current market price is, let's say, 63. Okay, so at that point, we're not going to call the contract because we haven't even reached our break-even point. We're going to lose more money if we call that contract at $63. Okay, so we'll rather just let it expire. Okay, now so that's that right there. Here it is. So the maximum gain for calls, it's pretty much going to be infinity. It can go as high as possible. Now, maximum loss, it's going to be the total amount that you put in there for your premium. So if you put $100 for your premium, that's all you're going to lose. You're not going to lose anything more. Okay.
Wait, question. So you just always let it expire if you're, I guess, under your
Yep.
break even?
Yep. If you're under that break-even point, most of the time you're going to let it expire.
Got it.
And the reason you let it expire because there's no point in pulling out because I mean you already lost money.
Exactly. So if you call it, you're going to lose more money pretty much.
Okay, cool.
All right. Let's keep going on to it.
Oscar, this is a silly question, but like let's say somebody has a call and then they're trying to sell it, but there's no buyer. Like what happens then?
I don't know, supply and demand. Someone's gonna get it.
Oh yeah? Like there's never been a point where like there's no buyer.
No,
All right, for sure. Thank
remember
you.
everything's in the open market. Someone's gonna buy it.
That it makes sense.
Okay, let's go right here as a little example. All right, cool. So here we have long one, July 40, call it 3. So now for us to find the break-even point, we're gonna add the strike price. So what's the strike price?
40.
43.
And then we're gonna add it with what?
3.
Yep, 3, the premium, so 43. That's our break-even point. Okay, so now, in order for us to actually make money, make it profitable, we have to be above 43. Okay, for a call, what's going to be the maximum gain? What's the maximum gain for a call?
Infinity.
Limited.
There you go, infinity. It can go as high as possible. Okay, the maximum loss. what's the maximum loss for a call contract?
Whatever they paid or whatever they put in.
Exactly, their premium. That's all they're gonna lose. So in this case, if their premium is 3, there's gonna be 3 times $100. Bum, bum, bum. Let me get that. Let me clears out. Let's keep going. Let's go now here to short call. Let's go with the example here below here. All right. So here we have short call. So for a short call, remember the call sellers are bearish. So remember, anytime in doubt where you're kind of confused, just draw out the chart. So you have here call, put, long, short, bam, 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 bam. So now we're looking at short calls. Right here, we're bearish. And then right here, we're the writer. Okay. There we go. An investor can profit if the strike price falls. Okay, so right here, we're as a writer, we are an investor. So all the time when you answer the question for calls and puts, you have to understand if we are an investor or if we're a buyer. That makes a completely different way in how you're going to solve that problem. Okay, so always make sure you think about that back of your head. Okay. All right, so break-even point, we're going to solve it the same way we did before, where it's going to be the break-even is equal the strike plus premium. Okay, so overall, the maximum gain for us here, okay, is the premium received. Okay, so now why do you think the maximum gain is going to be the premium?
Because they're selling the contract.
Exactly. We wrote the contract, we sold to a buyer, and then we're hoping that buyer does not exercise it. If they don't exercise it, we keep that premium. We don't have to do no work. We're going to keep it. Okay. And then right here, the maximum loss. The maximum loss can be infinity because it can go as high as possible. The writer could be forced to buy the stock at a potentially unlimited price if the option is exercised by the buyer for delivery at the strike price. So if it goes up and up and up, it goes to infinity, you can lose money pretty much. Okay, so here's example 1. So we have here short call, so automatically we want it to go down, and we're a writer. Okay, so the break-even point is going to be the strike price plus the premium, so 40 plus 3 is 43. So at or below 43, the call writer is profitable. Okay, maximum gain is going to be 3 times 100. There it is, $300. Maximum loss is going to be unlimited, because what if it goes to infinity for that price to go up and up and up? All right, any questions so far? Any questions? All right, perfect. And right here's like a little table. You guys can use this as a little cheat sheet to help you memorize the difference between the calls, the buyer, the seller, to find out the difference. All right, so now we have here, how many more pages do we have? Like 7 more pages. All right, cool. So here we have puts. So for puts, overall, we're expecting the price to go down. Okay, so for break even, it's the same way. We're gonna do the break even is equal to premium plus strike. Okay, and then maximum gain for puts, it's gonna be this.
So break even is basically the same thing for puts and calls.
Yep, same thing.
It only just changes when it's, I guess, what maximum gain and loss, right?
Yep.
Okay.
Okay, is the option strike price less the amount of the premium paid? There it is. And then maximum loss, the most the put buyer can lose is the premium paid. Okay. Yeah, the most tedious part for the exam is if they give you a question about like maximum gain, maximum loss. Because for those questions, you gotta think about it like for a second. Okay, perfect. All right, I'm gonna skip this part here. Pretty straightforward. All right. So I want to try and do a quiz for you guys. All right, so hedging risk with options. So right here, the way you could hedge an option is if you pretty much buy insurance. And that insurance is going to protect you in the event it goes in the opposite direction. Okay, so let's say that you have a call. Okay, and you're like, oh my goodness, it's going to go down. So at that point, you're going to buy a protected put. So what you want to imagine here is going to be the opposite for protected puts. If you have a call, you're going to buy a protected put. There it is. An investor who is long the stock bullish could buy a put option as a hedge against the stock falling in value. Does that make sense? Okay, the put would ensure that the client could sell the stock at no less than the option strike price if the share price declines. Effectively, the put locks in a minimum sell price if the long position moves the wrong way. This position is sometimes called a Mary put. Okay, but honestly, for the exam, all you gotta know is this first sentence. That's what it does. Okay, and then right here is protective calls. So protective calls is for investors where they think the price is going to go up and they're going to buy insurance in case it goes up in the other direction. That's it. Okay, so remember, if you're bearish, you think it's gonna be going down, but you're like, Leroy, oh my goodness, I think it's gonna be going up. So you're gonna buy a contract that's a call. That's why it's called a protective call in the event that it goes up. Okay. Let's keep going.
So essentially, it's kind of opposite of what it was the first
Yep.
time.
Exactly, it's the opposite.
Oscar had a quick question. So in regards to the protective or the hedging, you're always going to be in the long position, right?
Say again?
So in either position, if you're trying to hedge, whatever position you have, you're still going to buy, or you're going to be in the long position. Is that right?
I can't remember that part, but if you're saying about like if you have a long call right here where you think it'll go up, you're gonna have this position here.
Yeah, which would be like a long put, right?
No, yeah, protected put, exactly. It's a long put.
Yeah. So it's always going to be the long position.
Yes, but just remember this part, protected put.
All right.
Don't confuse it with long put. That's completely different.
Okay.
This right here, it's insurance. In the event it goes in the opposite direction.
Okay.
So protective, memorize that with insurance in case it goes in the opposite direction. Okay, let's keep going. All right, so anytime when you write a call option, you can either have it covered or uncovered. So covered, we're gonna have the stocks in our disposable. We're gonna have it. It's kind of like clothes. Okay. Now uncovered, it's naked. We don't have those stocks in place. So when they call it, we're like, oh my goodness. Now we have to go out there and buy the stock at whatever price is currently at in the market. Okay. Does that make sense? All right, cool, easy peasy. All right, just read this paragraph here while I get some water. All right, you guys read it? All right, perfect. So here it talks about like writing a put option, right? So here it says covered. If the contract is covered, the writer has sufficient cash available to buy the stock. This ensures the writer ability to perform purchase should the owner exercise the contract. Okay, and then uncover naked. They're not going to have enough money to actually cover the call. Here it is. If the contract is exercised by the owner, the writer will need to come up with the cash from somewhere. Okay, and then covered against a short stock. Okay. We're going to skip that. Oh shit, I forgot about this thing here. All right, so here it talks about the options clearing corporation. Not that hard. So this right here, trying to look for a little cheat sheet. There it is. So for the options account, for the options clearing corporation, all you have to pretty much memorize is this diagram here. Customer wants to trade. Registered representative determines suitability of options trading. Okay, and what does the word suitability mean? What does it mean?
Are they suitable for that?
Yep.
For that option.
How aggressive are they? Are they conservative, moderate? Okay, and then here, option disclosure this document is provided at or before account approval, and an option account is approved by ROP. What does ROP stand for?
Rate of premium.
No,
Principles.
no, it's
Return
good.
on premium.
No, it's gonna be registered option.
Special principle.
Yeah.
Options principle or
Yep.
Registered option principle.
Let me go back here. Here it is. Registered options principle.
Okay, cool.
That's your poncho, your main guy that's gonna be approving the option, saying yes or no, it's gonna be approved. Okay. First trade may take place immediately following account approval. Option contracts are bought or sold T+1 payments of premium. Okay, sign option agreement, return within 15 days of account approval. So if we don't get that signed agreement within that 15 days, pretty much the only stuff that they can do is close their transactions in the account. They can't make any new positions. Okay, does that make sense? All right, cool. I'm kind of gonna skip this here. These are just the different terms for trading. You got settlement here, expiration days gonna be midnight, exercise. Okay. Let's do a quiz. Cool, cool. You guys learning?
Yes, sir.
All right, let's go. Let's assume. All right, let's go. Custom quiz. Let's do unit 3 derivatives. 20 questions. I think I have some 20 questions. All right. Let me get a pen. Dot. All right, cool. Which define describes the position in a call option on a stock with the strike price of 20 and a premium of 7 and a current market of 26. So you have a call.
In the money.
We want to go up, right? Strike price 20 and it's 26. Around, we're in the money, right? So that's correct. Right? But let's not jump to conclusions. So now we have here the 26 minus 20. Where right now we're finding it has interest. So right now the intrinsic value is going to be 6. Okay, and then now the premium is 7, which does not equal 7, right? So there's no parity. So B is wrong. It's not C, it's in the money. And then B is wrong because it's in the money. Because if it's at the money, this right will be 20. So it should be A. Easy, right? Let's clear this out. All right. If an investor is long an option contract and wishes to exercise the contract, the investor notifies the broker-dealer, who then notifies
Is it A?
Hey,
Yeah, this one just comes out like actually knowing it. So it should be A. Read it. Remember, we're talking about options. So options are regulated by A. All right. What method is used to assign exercise notices to broker-dealers with short positions by options clearing corporations? This one, once again, is literally, you got to know it. So if you don't know it, you're going to get it wrong.
see?
See? It's A, random selection. All right, read it. You guys read it?
Yes.
All right. A customer who has written an option contract receives an assignment notice. The customer is probably gonna have to guess is something either A or B, the word's obligated.
B.
Huh? B? There it is, B. You guys get it?
No.
No? So right here, the beginning part says a customer who has written an option contract So if I write an option contract, I'm going to be obligated to do something if the buyer calls it. So I'm looking for that kind of wording in the responses. So I'll
Does this, sorry, Oscar, does this kind of go back to what you were saying? You have to be very careful and identify if you're the buyer or the investor.
exactly. Yep, that's exactly it. You have to identify if you're the buyer or if you're the seller / writer.
Okay, that makes sense.
All right, an investor bought a put option and in time, the underlying security declined below the strike price of the put. The put would probably be, here it is. An investor bought a put option, all right here, once again. Let me get a pen here. So an investor bought a put option. It declined below the strike the price of the put. The put would probably be,
Be exercised.
yep, B. So it should be.
So exercise, that means like active, like or
It's gonna be called.
is getting what?
It should be called.
Call.
So someone's gonna call the contract. Does that answer your question?
Yes.
Because it's in the money for us here. If it's below that price, someone's gonna call it. All right, let's clear this out. All right, an investor is long a January 30. Okay, cool. So we have a long call. The maximum loss for the position is going to be, okay, perfect.
200.
You sure?
Yes.
That should be $200.
Yes, it should
Whatever
be
you,
200.
it's whatever you put for the premium. There it is. All right, so for this question here, what will be the maximum gain?
Infinity.
And why is it infinity?
Because it only goes up.
Yep. All right. All right, regarding option positions, which of the following statements is true? All right, let's give my little pen again. This one you're gonna have to think a little more in depth. All right, regarding option positions, which of the following statements is true? Let me see. So now right here, it might help if I draw out the chart here. So we have your call, put, long, short, and then buyer, writer. All right, cool. There we go. So now here, so we have your call writers may be obligated to purchase the underlying. Okay, so this you have to use a chart. I think I did the chart correctly. Can't remember. Is it correct in the PDF? I think it is.
Yeah, I think it's right.
Let's go back here as a
That's
case.
correct.
That's correct.
Mhm.
All right, cool. So using that chart, answer that question. Just look at it. What do you think what do you guys think it is? The key thing here is giving me the word of obligated. So for me, I'm like, okay, cool. So I have a call writer here. They're going to be obligated to sell if it goes up. So looking for that here. So we're going to look for call writer. Maybe obligated to purchase the underlying security, and put writers
That'll be D.
are obligated to sell underlying. I think it might be A. I don't know. What do you think?
No, it's Oscar. I believe it's B.
B? Let's see. The good thing is I'm not taking the exam. You guys are.
Can you explain that one more time, please?
Here it is. So buyers of options have rights, and writers, sellers of options, may be in an obligatory position. If the buyer exercises a contract, call buyers have the right to purchase stock. Okay? And put buyers have the right to sell a stock. Call writers may be obligated to sell a stock, while put writers may be obligated to buy the stock. So once again, this is just something you got to read and like just grind your head till it actually clicks. You know,
Okay, so from what I understood, what you had said earlier, every time you see writer, you just have to identify that where they're obligated
Mhm.
to purchase.
Yep.
Okay.
All right, keep going. Those are tough ones. We got to think about it. All right, when the options clearing corporation, OCC, receives a notice to exercise, it will assign that notice to. This one, you got to know it.
Would it be C, a short broker dealer?
You think it's C? There it is, C. Why is it C, Angel?
Because when you're short, you're pretty much obligated to do whatever the opposite contract is.
Got it. All right, the maximum gain on a short call is
Premium.
D. Oh, never mind. I thought it was D.
premium. We're halfway there. All right, for investors engaging in the trading of option contracts, which of the following is true? Buyers receive the premium. That's wrong, right? Because who receives the premium?
The seller.
The seller, right? That's wrong. A is wrong. B, sellers pay the premium. That's wrong, right?
Right.
And C, sellers receive the premium, which represents the right to exercise a contract. That one
Wrong.
kind of sounds right. I'm not sure about the last part. And then D, buyers pay the premium for the right to exercise a contract.
That's correct.
So you think it's either C or D? What do you think it is?
D.
D? All right. All right, on a short put, when the premium equals the intrinsic value, the put, when the premium equals the intrinsic value. Oh, it's gonna be parity. Yeah, it should be parity, right?
Yeah.
Easy peasy. All right, your customer is long 1 October 55 put at 55. Customer break even point is break even point. How do you find it?
Premium plus the
Break-even,
strike price.
Yep,
Yeah.
premium plus strike. So in this case here, it's going to be
59.
59. So it should be 68.
Hey.
Wait. No,
Oh.
it's opposite for this one.
Hmm.
It's a put.
Oh, it's a put.
So for put, we want to go down.
Yeah.
All right, an investor is long a January 30 call at 2. So this one here, automatically, if it's a long call, so we want to go up. So we're just going to add the strike price plus the premium. So now it's going to be 32. Now it's right.
32, right?
All right. Options investors who are, if you're bullish on a stock, should buy calls. That sounds right. If you're bullish on a stock, you should buy puts. That sounds wrong, right?
Right.
So now we're going to cross out 2. All right, bearish on a stock should buy calls. That's wrong. So now it looks like it's between 1 and 4. So there it is, D. Should be D. Remember, order elimination is your best friend for the exam. Best friend. All right. All the following terms and phrases apply to the buy side of the options contract, except
That's an obligation.
this one. Not that. I think it's this one.
B.
Once again, this is like more of like you have to know it. All right, an option contract having no intrinsic value at expiration will likely be allowed.
To expire.
D.
There you go. There's no money in it. They're gonna let it expire. All right, which of the following pairs of option contracts is not in the money? If the strike price is 40 and the market price is 30. Okay, so now is not in the money. Okay, so now we're looking for the ones that are not in the money. So for these right here, the way that I would answer is I would draw out the little chart. Now if you're call, put, long, short, bam, 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 and then bam. Okay. So now, which of the following pairs of option contracts is not in the money?
So is it C?
You can see.
Yes.
That was B. Because we're saying it's not in the money.
Mm-hmm. So if it's gonna be something not in the money, I'm kind of lazy, so I'm just gonna circle these that are up. And I'm gonna look for long call and like short put.
Mhm.
So I'll put D maybe.
Mhm.
I just cheated.
That's way easier though. With the graph.
Yep. So all I did, I literally looked at this question here, and it's a put, right? So for puts, I want the arrow to go down, right? So now I look for the opposite direction arrow, and I look for long call, and then short put.
Oh, I got it. I got it
That's
backwards.
that's why you're saying to remember that equation, right? Because it comes in handy a lot.
Mm-hmm.
Or that graph, I mean.
Yeah.
Okay.
Oscar, this one still doesn't make sense to me. Why would a short call be not in the money if the strike price is 40 and the market price is 30? For a short call, it would be in the money, wouldn't it?
Depends on if it's a buyer or seller.
Well, you're selling at this point because it's a short call.
So in this case, you're selling. It gets confusing. Let's look at it again. All right, the maximum potential loss for an investor short a put option is what do you think it is? Just guess, just guess. We're already above 70%.
C?
D,
Oh, C.
it's B.
Right.
Read the description. You guys got it?
Yes.
All right. 19, the holder of an in the money option contract gives a do not exercise instruction to the broker dealer. This notice just means that they're not going to call the contract. So if anything, I'll probably just guess B.
B.
Because what if it's automatic? If they don't say anything, then it's going to get exercised by itself. All right, and then 20, a customer of a broker dealer makes it known that they would like to trade options in their account. The first step to accommodate the request is which of the following?
C.
A.
C.
Which one is it?
C.
I thought it was A.
It could be A, but it's already in a. Looks like he's already an established customer. But I would say between either A or C. It's A. Not bad.
Hey.
All right, that's it for tonight. You guys keep on studying. Tomorrow we're going over Unit 4.
Thank you,
Okay?
Oscar.
No problem.
Thank you so much, Oscar.
Thanks, Oscar.
No problem.
Thanks, man.
No problem.
Appreciate it.
Good one.
All right, bye.